upside, and I don't want to use the word, but I will, podunk towns, who's coming in there? Who's the big employer? Where's the population growth going to happen? Where's the income growth going to happen? And I would submit it's going to be better in some of these major metros.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Arn, welcome to the show.
Hey, Matt, great to be here. Thanks for the opportunity and look forward to having a nice chat about real estate and hopefully help your listeners improve their investing and do it profitably and safely.
Absolutely. Well, before we get into all of that, we like to start with the difficult questions. What's your favorite ice cream?
My favorite ice cream is probably strawberry.
Okay.
Yeah.
Now, you're based in the Greenville, South Carolina area. So if I find my way over that way, where is the best ice cream place in the Greenville area?
So my life partner, Laura, is the big ice cream aficionado, and she loves Kilwins, which I believe is a franchise, and they're throughout at least the Southeast. So her favorite is Kilwins right on Main Street in downtown Greenville.
Gotcha. Well, we will have to check it out next time I'm that way. But tell our listeners, where'd your real estate journey begin?
Yeah, so basically I was born and raised on the San Francisco Peninsula before it became Silicon Valley. Had a typical middle income American life, worked hard at school, went to college, went to grad school, got a degree in chemistry, master's degree in chemistry of all things. Wanted to return to the Bay Area, where my father had opened a residential brokerage business in Menlo Park, California, which is basically next to Palo Alto. And I think most people know what Palo Alto is. So I had the good fortune to sell residential real estate, invest in residential real estate in probably one of the best markets of the world for about 35 years. And about 10 years ago, moved to Greenville, South Carolina.
Now, your dad, you mentioned, started a brokerage business there in the 70s. Is that right? In the Bay Area?
So I joined, I got my license March 1978, and I would say he probably started early 70s. He was a born entrepreneur, probably started 4 or 5 businesses and failed miserably at all of them till he found his niche in real estate. And I think that's a fairly similar story. Entrepreneurs, they try, they fail, they keep trying, and eventually they find their kind of niche and calling. So he probably started at the age of 40 in the early 1970s, which is a little late to start, but he figured it out and did very well.
Yeah, this 1970s is when Menlo Park and that whole area really started to boom, kind of in the early 80s, late 80s. So I was going to ask, is it one of those things that the market really helped him succeed, or just kind of previous failures in entrepreneur, he knew what not to do at that point?
Yeah, so he was born in 1921. And if I have my dates correctly, he actually was a young kid living through the Depression. So very hard worker. If activity wasn't associated with providing for family and building security, he didn't have a lot of interest in it. So very hard worker. And certainly the price of Bay Area real estate in the time I was there, probably 10x, 20x over the 30, 35 years. So certainly the increase in the value of houses in the San Francisco Peninsula didn't hurt the brokerage business. Of course, it got very competitive, like it is in any great market. You're in Nashville. Nashville, I'm sure, is very competitive. So no different in the Bay Area. But when I started, average home price in Menlo Park, Palo Alto may have been 200, 300,000. And by the time I left in 2014, it was probably closer to 2.5 million. So quite dramatic. And certainly we benefited. People who own property there benefited from it too.
Yeah. So when you came to join the residential brokerage business, were you just selling homes then, or were you all buying homes, flipping them, doing any kind of that stuff?
Yeah, great question. So basically, I got out of college. I had a teaching assistantship to pay for grad school. So I got out of college, basically had no money, went to work selling residential. So I essentially started with the brokerage. Um, my father, unlike many people in the brokerage business, was also an investor. And kind of what he said to me was, Arn, the brokerage business is a great way to create income. But if you want to create wealth and financial security, you really need to invest in real estate. And so he was a single family home investor, and I kind of followed in his footsteps. And in the 1980s, you could actually buy houses in the San Francisco Bay Area that would work as rentals. Of course, 20, 30 years later, that didn't those no longer penciled. And I would say it's for our listeners, many of whom probably have pretty high income, high demanding jobs. And I would kind of urge them to put some of that capital to work in real estate investments. The way I always kind of look at it is every morning, those dollars, that capital I have invested goes to work for me. They put on their tool belt, they put on their suit and tie, whatever, and they're working for me no matter what I'm doing. And so uh, that was a lesson my father instilled in me. And so as the brokerage business did better and I made more money, I started buying rentals. And like many people, you buy your first house, you live in it a couple years, you're maybe making more money, you can afford something a little nicer. Well, what do you do with that first house? You keep it as a rental. And now all of a sudden you're an investor. And from there, it kind of snowballs. And that's the path I followed.
I feel like you just repeated my history and my story is started working, started getting promoted in that job. And then I got a job offer to move to Austin, Texas from Nashville. And I was like, man, Nashville's a booming market. I'll just hold this property. And it was one of the easiest things I ever did because the tenant was so great that I'm like, man, this is so easy. And then I just decided, hey, why not go ahead and buy a couple more of these? Turned out that I ended up moving back to Nashville, so I kind of took over that property and started living in it again. But it was one of the best decisions I ever made.
Yeah, and I think the economy, the market has been a little unsettled the last 12 to 24 months, which of course is only natural after 7 or 8 boom years, which we had from 2012 to 2022, 2021. Uh, and so people are nervous, but I would say, can anybody make logical, rational arguments that would suggest the price or the cost of housing is going to be less 5 to 10 years from now? I don't see it. Cost of labor is going to go up. Cost of materials are going to go up. Population is going to grow. So one of the great things about real estate is you don't have to be the smartest guy in the room. You just need to be prudent, buy good property, quality locations, and over long term, I believe you'll win.
And be disciplined.
And be disciplined, yes. And that means don't make any mistakes. And for me, to make a sports analogy, my investing is about hitting line drive base hits. I don't swing for the fences. I don't swing for the grand slam. Some people do it and some people hit the grand slam, but often maybe you make a mistake and strike out. And so for me, real estate's always been slow and steady accumulation of cash flow, equity, net worth over time. And if you kind of, as you mentioned the word discipline, put together a disciplined investing program over 5, 10 years, you're going to significantly improve your financial situation. And again, you don't have to be the smartest guy in the room or the smartest gal in the room. You just have to be prudent and disciplined, and I think you'll win.
Yeah, to that point around time, I think I saw a stat this morning that if Warren Buffett had started investing when he was 35 instead of when he was 10, he would have only been worth like $25 million versus the 90 billion whatever that he is today. So it's
Yes.
discipline, it's time, it's not making mistakes. But I want to give some context here. So you went to go be a residential broker right before the savings and loan crisis. So the savings and loan crisis back in the 80s and early 90s was a huge real estate meltdown. But you were also investing in the time of high inflation. We're coming out of that period, hopefully, of high inflation. Do you remember what your mortgage rate was on the first property that you purchased?
Yes, I do. It's indelibly etched in my mind. So I think my first purchase was, I want to say, September 1980. And I paid 11 and three quarters fixed, got a loan from Wells Fargo. I remember my mortgage payment, 868.08, seemed like a lot of money. I was afraid, blah, blah, blah. And then right at that point, by spring of 1981, interest rates were up to about 16.5% adjustable rate mortgages. And I even was still able to sell homes at that rate. Uh, and then, yes, later on, the S&L crisis, which a lot of people don't really remember or maybe aren't old enough to remember, but back in the day, we actually had something called savings and loans. I don't think we have them anymore. We have banks, we have credit unions, but one third of all US savings and loans went under. There was a massive liquidity crunch, and that impacted the market. And which brings up an important point. If you set your investing up properly, and for me, that's relatively low leverage fixed rate debt, having some ample cash reserves, uh, and knowing how to professionally operate the property, you can ride out the inevitable rainy days. And so 1981, 82 was a rainy time. The savings and loan was, the Great Recession was. But really, if you set it up properly, you can ride out those storms, and then once they pass, you benefit. The way I like to think about it, I describe properties as self-supporting, which basically means they're cash flowing to the degree there's a buffer. So if you get an unexpected repair or rents drop a little bit, the property still supports itself. And at that point, you want the value to go up. But if it happens to drop a little bit, it's no big deal because the property's paying for itself and you just keep owning it and there's no trouble. Where you get into trouble is where you get over leveraged, something bad happens, and now you don't have the capital to kind of ride out the storm. And that's when people get in trouble. So if you can avoid that scenario, you're going to be okay even through a little turbulence like 16.5% interest rates, savings and loan crisis, and so forth. So that's kind of been my approach.
Yeah, I always like to say you lose money in real estate when you're forced to sell. You're forced to sell when you don't have tenants, when your debt is floating and it floats up on you, when you have an adjustable rate mortgage that readjusts or a balloon payment that's due and now the property's worth less. Like if you can just hold the property over a long enough time period, you're probably going to end up in a good situation. But if you're
Yes.
forced to sell, that's a guaranteed way to lose money in real estate. You mentioned operating reserves. So this is an interesting topic around how much operating reserves do you, so now you're in multifamily, I guess let me frame it up. And we'll get into kind of multifamily and the markets that you go into. But in multifamily, when you acquire a property, how much operating reserves are you looking to keep in your operating account?
Yeah, I'm probably a little bit of a nut and overly conservative, uh, but I like to probably have about 5,000 a door.
Okay.
So if I own a 30 unit building, I like to have a minimum 150,000 in the bank that's not earmarked for anything. And granted, raising that capital, having that ample cash reserves. So basically, we parked our cash reserves in a money market account now, and we're getting 5%. Our investors get that money. It's just like another rent payment. So we try to do about 5,000. And when you think about it, boy, that maybe sounds like a lot, but an HVAC unit goes out, that's $6,000 or $7,000 right there. Hot water heater today is probably 1,300, 1,400. I don't know what it is in your market, but to have just a hot water heater, it's about that. So I try to do about 5,000 a door. That may be a little on the conservative side, but I call it my Somonix account, which basically means I can sleep at night knowing that money's there. So at Spark Investment Group, we actually like the smaller multifamily. So a lot of our properties are 30 to 50 units. And honestly, in a lot of those properties, we have close to $250,000 in money markets for each property. So it's actually more than 5 a door. But I think for your listeners, if you could shoot for 5 a door, going to be good. If you have a little single family house, it's going to be 10K for a roof. So at least have 5 put away, and you can manage on the rest. So 5 a door is probably a good number to shoot for.
Why do you mentioned 30 to 50 units. Typically on podcasts, you hear, hey, you need 100 a door to outsource management and all that sort of stuff. I'm assuming you're doing the property management in-house, but why do you shoot for that kind of 30 to 50 doors for an apartment complex?
Yes. Well, number one, I would say you're exactly spot on as to why, or at least one of the reasons why. Basically, Spark Investment Group is 3 guys, Arn, Dan, and Brian. Brian's kind of the property manager, our asset manager, the operator. He runs the day to day. And he's kind of set up as a residential property manager as opposed to having on-site leasing staff. So that's number one. Number two, he's an equal part of the general partner. So effectively, he's also ownership. So we're essentially vertically integrated where the property management function is within the general partnership ownership structure. The other reason we like smaller ones is often with apartments, we might buy a value add property, or we might buy a property that's been owned by a family, a mom and pop operator for 30 years. And so there's a lot of work in one, fixing the property up, updating it. Sometimes the current ownership runs kind of a lax operation in terms of collections and tenant qualification. So there's always some work involved when you take over a new property, a new asset. And for us, we like to kind of get in, and even on a 30 to 50 unit building, honestly, it takes us 12 to 18 months to really get control of that property, go through the tenants that maybe aren't the best, get the units upgraded, get the rents to market. So we like to go in, get it all done 12 to 18 months. Now we're operating on cruise control, and we can go then find the next property and do that. As opposed to a 200 unit property, some of my experience would be we solve a problem here, but now a problem breaks out over there. It's like running around trying to put your finger in a dike. And certainly there's advantages to scaling your operation. And the other thing I would say is for real estate investors, and this is something I really believe, to the degree we can niche down, you're going to be more successful. So we only do multifamily. I know you do a variety of things. And as a passive investor, I'm all for diversification. So yeah, do some multifamily, do some self-storage, do some mobile homes, but work with operators that are experts in each of those asset classes. And so for me, it's multifamily. It's the smaller multifamily. And the other part is we basically only do Greenville, South Carolina, or the upstate of South Carolina. It's about 9 counties, 1 million people. And we believe in kind of local oversight of the property, local market knowledge, and that's kind of our competitive advantage.
So Greenville is a market that was unknown to a lot of investors for many years, and then it popped on everybody's radar back in about 2019. A lot of good job growth there, a lot of good income growth with that job growth because they're great jobs. Is there a risk to oversaturation in a specific market? And specifically, what I'm trying to gauge from this conversation is a lot of supply has hit the market over the past 2 years. And shovels went into the ground everywhere. And so if you own assets where there's no restrictions on the amount of shovels that go in the ground, all of a sudden you can be out of whack in supply and demand. So is there a risk with any sort of oversaturation in a market?
Yeah, great question. And the answer is yes. I'm a big believer in diversification. And again, as a passive investor, you can get yourself a little bit of Boise, you can get yourself a little bit of Nashville, you can get some Austin, you can get some Greenville. So from a limited partner investor, yes, diversification is great. And in the Greenville market specifically, we do now have an oversupply of the Class A luxury building, no doubt. I've been in Greenville 10 years and it's absolutely exploded. There's $2 or $3 billion developments going on, and it's not all multifamily, it's mixed use, but it's residential sometimes. So currently in Greenville, I would say the Class A luxury building, there is an oversupply. We tend to shoot for more. We don't really like the real low income. We like to do what we consider bread and butter, steak and potatoes, kind of that middle income rent, which in Greenville is $1,300-$1,500 a month. In Nashville, maybe it's $1,700-$1,900. I don't know Nashville market as well, but we kind of like to hit that sweet middle spot. And so our assets aren't competing with the Class A. And we find at the lower rent level, there are just issues with collections and so on and so forth. The only other thing I would say, and it's something I tell people quite often, would you rather be investing in an area where people are investing billions of dollars, or would you rather invest in an area that nobody's investing in? So to me, real estate's cyclical. And if you've been in it long enough, you just realize it's cyclical and you don't freak out. It's just all it's logical and natural. It's just part of the game. And so for me, I would always rather be in an area where capital is coming in, even if it creates a slight oversupply, because ultimately long term, that just tells me it's a more vibrant market and in my mind offers more upside long term. I think being in Nashville, hey, Austin, Texas, where I invested for many years, is certainly suffering from oversupply. Okay. Oh, yeah. But if you're a long-term investor, are you going to argue that Austin is no longer a great place to invest? I would say, no, you're out of your mind. The same factors that drove Austin, yes, created some overbuilding, and it's going to take a year or two to absorb that. But the factors in terms of tech, the state government, the state university, the population going in, ultimately that's going to win the day for Austin. So what's happening in Austin and many of these really desirable markets is just kind of natural. 10 years of run up, you're going to have a little pullback. And as all that really does, in my opinion, is set the plateau for the next run up. So I'd rather go to markets that are a little overheated than ones that nobody really cares about and looks at, because I just don't see there's much upside. And I don't want to use the word, but I will, podunk towns. Who's coming in there? Who's the big employer? Where's the population growth going to happen? Where's the income growth going to happen? And I would submit it's going to be better in some of these major metros.
Yeah, it goes back to that point of like, if you're not forced to sell, right? So if you can, if your market gets oversupplied and you're not on floating rate debt, you can lower rents because you already know what your cost is going to be. If your market gets oversupplied and you're on floating rate, can you extend it long enough for that supply to be absorbed? I also think that the more I've been in this business, the more I realize a good market can hide a bad deal. A bad market will destroy even the best deal. So I'm not going to pick on Akron or Cleveland, Ohio, but when 1 million people move out of your metropolitan area in 20 years, there's not a lot you can do to kind of overcome that, no matter what kind of amenities you have.
100%. And you've mentioned kind of fixed rate and adjustable rate debt. And that's a big reason I'm a big believer in fixed rate debt, because if you can make a deal work with fixed rate debt and you can fix your debt cost for 5 to 10 years, that's the biggest amount of money coming out of an investor's pocket. Now, technically, it's not an operating expense, so I need to be careful here. But it is, the debt service is the biggest item investors pay. So think about it. If you can fix that for a 10-year period, and a lot of people will ask me, so we know the subprime crisis, the Great Recession. How did that all happen? Well, it basically happened with low money down, adjustable rate mortgages, no documentation, no qualification. Okay. The multifamily markets had a little rough time here the last year. And what is that? They've got bridge debt, floating rate debt. It's just called floating rate. It's the same as adjustable. And the no documentation, the analogy there is a lot of this floating bridge debt was based on pro forma 2 years in the future. So basically, it was phantom income, which is similar to a no doc loan for an owner occupant buyer. So all the same factors that caused the Great Recession and the subprime and the residential market have basically been repeated in the multifamily market. And the other thing I would say is there are going to be some multifamily operators that are in trouble. But I would say in the whole universe of multifamily ownership, multifamily loans, maybe 5% of the loans at most are going to be in trouble, because a lot of this multifamily stuff, just like any other property, has been owned by families for generations or for years. All those people are perfectly set. It's only people who bought maybe 2022 late, 2023 adjustable rate, floating rate bridge debt that are in trouble. So keep in mind, that's not 50% of the market. It's more like about 5%. So overall, most multifamily is pretty healthy.
Yeah, I would take it back to the back half of 2021. I think that's when we saw cap rates kind of at the lowest level, and you're buying at a 3.5 cap. You put 4.5% debt on it that floats. Now all of a sudden you wake up and that's 7.5% debt, and your cap is 6, 5.5. You're in a world of trouble. But do you take on investor capital to do your investments?
Yes. So basically, I'm a what would be called a sponsor syndicator. I certainly own assets in my own portfolio, but most of the multifamily is with other investors. Yes.
So I think the question I want to ask with that then is, because there's this balance of floating rate debt, no prepayment penalties, fixed rate debt, prepayment penalties. And a lot of folks, I think, got in trouble in 2020, 2021, 2022 by taking out floating rate debt because they had just sold a property that they acquired 18 months ago and they flipped it for a 1.5x multiple, and they're thinking this game is easy. And they're like, why would I burden myself with a prepayment penalty on fixed rate debt when I'm limiting my options to go sell? And when you start to run the numbers, like, that's a fair argument and decision that you have to make of, hey, I can spend $20,000 now and cap my interest rate debt, or I can fix it, but I've got to pay $2 million in the future if I sell it before my 10-year term, or, those are made up numbers, but it is a real difference in those costs. So how do you balance that, knowing that you want to make sure you secure the highest offer at the right timing, but also being prudent and safe with your capital stack?
Hey, fellow investors. Before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Yeah, it's a great summary. And just to further elucidate it, most large multifamily loans that are fixed rate are so-called agency debt. And the agency debt has these prepayment penalties. There's a term yield maintenance, there's defeasance, there's a step-down prepay. So there's a variety of structures with the prepay. So I think what I would say is, if you're going to do floating rate bridge debt, floating rate debt, I think you would want to be a very experienced, sophisticated operator, right? Because, this may not be exactly correct, but to a certain degree, you're playing high stakes poker. Right? You're sitting there. Do I go floating bridge? Do I get fixed and worry about the prepayment penalty later? So I think if you're going to go the floating rate bridge debt way, you should have some experience under your belt, because there are ways to handle it and minimize risk. Most of the deals that Spark Investment Group does, we tend to do multifamily deals, 3, 4, 5 million. And so often we go to kind of local bank debt or credit union debt, and there we get the 5-year fix, no prepay. We do have one agency, Freddie small balance loan, and on that one we went with step down prepay. And because with step down, you know exactly what the penalty is going to be every year. It's like, in our case, it might have been, I don't remember, 5.54322%. The yield maintenance and the defeasance, you don't really know, because it's a function of what interest rates are when you pay the loan off. Because essentially it's set up where the lender is guaranteed a certain return over the length of the loan. And one reason the yield maintenance penalties went way up is rates went way down, and so the penalty went up. So it's a fine calculus that you got to go through. I tend to be a little more conservative. I'd rather go with the fixed rate debt, but there are uses for the floating rate debt, and just understand it and have plan B and C in place, so you can adjust and do the rate caps and do whatever you need to do to kind of manage that.
Yeah, I think I would love to hear your commentary back to this, but the way I've kind of rationalized it in my head here recently over the past couple of years is, if you have a short-term business plan, then you need short-term debt, such as a floating rate debt. Short-term business plan would be, we're going to buy this property. We're going to do some improvements. Those improvements are going to take X number of months, not years. And we will refinance or sell the property after we have extracted the value from it. If you are buying a brand new property, a Class A property, a development, something that is a longer term play, you want to go ahead and fix your debt, because you're just taking a piece of risk off the table. And you might be wrong in taking that piece of risk off the table, but you certainly know that you have taken it off the table at that point, and there's no time risk that could come in and throw your deal sideways.
Yeah, Matt, I think that's a great way to express it. Shorter term business plan, floating rate debt probably takes a little precedence. So I think that's a great way to think about it. I tend to be a long-term investor. We have never sold any of our assets, so we hold them. um, but and I think the other thing is um, we we went through a once in a lifetime period with COVID and our reaction to COVID in terms of one, printing a lot of money, and we're dealing with some of the ramifications of that now, and two, historically low rates to kind of keep the economy on life support, where at one hand we're trying to shut everything down and how do we keep it going. So uh, there was a window there where values kind of went crazy and flipping apartment buildings became possible. I'd submit historically, if you look at it over a 30, 40-year period, I would say flipping apartments wasn't standard operating procedure. More what I would see is people who started accumulating apartments or 1031 into continually bigger apartments and holding them long term. Um, so it'll be interesting to see if we ever get back to a case where it's relatively easy. And you mentioned about turning a building over quickly in 12 months. You get a 100-unit building and you got a plan and you know how to execute and you get it done. That goes back to the experience too. If you have an experienced team that's done this and is tried and true, they can get that thing turned around quickly. So the experience is important in the execution of the value add business plan, because time is money. And so the quicker you can kind of go through it, the better off you are.
Yeah. So you're a guy that's, again, been through the S&L crisis, the dot-com boom in California, the GFC, and now whatever we're calling the COVID era of stimulus and then restrictive monetary policy. All real estate is local. There's no one real estate market. It's real estate markets underneath the real estate market. But take us, 12 to 24 months in the future. Talk to us about like where you think we're going to come out of this restrictive monetary policy phase that we're in, and where you see kind of the real estate market, at least in Greenville, South Carolina, over the next 12 to 24 months.
Yeah, so basically, I'm bullish on the real estate market, and that would be in Greenville and a lot of other markets around the country. Through my lifetime, I've kind of seen these 10-year cycles, 6, 7 years of boom, a year or two of correction, a year or two of plateau, and then another boom. And I think we're just about entering the plateau period. And again, let me clarify. I'm speaking just about multifamily and maybe residential, and an analysis of office industrial could be different, but strictly residential, just to clarify. I think we're just entering the period of some stabilization. Deal flow has dropped significantly. It now appears rates are going to be on a downward path. Not that we're going to get back to 3, but I can see we can get 5% debt costs pretty soon. So I think we're now entering a stabilization period, which in 12 to 18 months, I believe we'll start to come out of, and I think we'll then start to see appreciating values. So on the last couple acquisitions we did at Spark, which were actually new construction properties, not that we built them out of the ground, we bought them from the builder at CO, at certificate of occupancy. We're taking 7% fixed rate debt, 5 years, no prepay. We're leasing these properties up. And our plan is in a year or two, hopefully debt costs is down to about 5.5. We'll refi then into probably agency debt and hold it 5 to 7 years. So I believe we're at the plateau. I think there's opportunities going to be there. Long term, I'm bullish. The population growth isn't going to stop. The cost of housing, the cost of anything's not going to go down. And the other thing I say to investors is I'd always rather be 6 months early than 6 months late.
Amen.
Because, uh, you know, the data is all important. Data. Okay, that's all important. But the markets are also emotional and they're psychological. And we see this in the stock market all the time. We see it in the real estate market. FOMO, fear of missing out. When the psychology changes, everybody jumps back in. And in multifamily, we keep hearing about all this dry powder on the sideline. And I believe there is a lot of capital out there waiting for the right time to jump back in the market. And I think we're approaching it fairly quickly. And if you wait till it's obvious it's taking up, you're going to be in a much more competitive situation. And the guys or gals with the biggest bank accounts are the ones who are going to win that battle. So maybe it makes sense to get in a little earlier before it's so hot, even though knowing you might have 6 to 12 months of flat. But if you could get a good quality asset today at a reasonable price and it will pencil at the current debt cost, I'm a buyer because I think the cost of debt will go down and the market will go up. So that's my crystal ball.
Yeah, I love it. I got a call from one of our investors who has been in the business for about 40 years, manages about 1,500 units in a smaller town, owns about 60 to 120 units at any given time in that town, single family homes. And I remember, the Fed had just raised rates by 500 bips. We were all getting slaughtered, figuring out like what's going to happen. He's like, man, I'm a net buyer right now. I am buying anything I can get my hands on because people are distressed. And I will tell you this, he lived through the 70s SNL inflation crisis as well. He's like, once they take the turn to lower markets again, my pricing will appreciate so fast that I won't be able to hold on to these because people will offer me good prices. So I'm a general believer in exactly what you just said around, I think the Fed is on a march to 4.25, 4.5 Fed funds rate, which means we have about 100 bips to drop to go. If we drop 100, the multifamily market should go up in reverse of that. So it should be a good couple of years here.
And the other thing I would say, like people will always ask me, or it's a topic of conversation on podcasts, what's the best market to invest in? And people have their own opinions. What I say is the best market to invest in is the market you know best. So all you investors all across the country, you're in your market. You know those neighborhoods. You know those markets. You know what areas are improving and which are declining. Use that local market knowledge. And if you can buy some good quality property at a reasonable price now, please do it. 3-4 years from now, you'll be happy. So use that local market knowledge to make smart purchases now. And again, that doesn't mean you run out and buy everything. You be strategic, you be smart about it, you make good values. And like for me, I'm not, I don't know, how do I say this? I love to buy a deal, but honestly, Warren Buffett once said, I'd rather pay a fair price for a good company than a good price for a fair company. And for me, real estate's the same way. I'd rather pay a fair price for a good property. That's how I kind of approach it. So if I can get it at a little discount, I'm happy. But it's not so much about getting it at a discount. It's buying that quality, that value, because I know over time it's going to win and the market will recognize that.
Yep. Well, Arn, great conversation. I want to switch us now to our last round. We call this the 4 toppings. Our first one is, what is your favorite book, or what is a book you've just read recently that's given you a paradigm shift?
Recently, I would say Who Not How by, I think it's Dan
Sullivan.
Campbell?
Sullivan.
Okay. So one of the great things, and we didn't really cover it, one of the great things about moving to commercial real estate, and let's say multifamily in my case, is we call it a team sport. And so single family investing can sometimes be kind of a solitary activity, where commercial real estate, multifamily, you can partner up with people. And so that book was really instrumental in helping me find my two partners who have skill sets that I don't have, who enjoy things that I don't. And it allows me to do what I do best. They do what they do best. So Who Not How, it's a great book and I'd recommend it.
Yeah, absolutely. Our second one is, what is the best piece of advice you've ever received?
It was probably from my dad, and I was only about 23, and I didn't quite understand it then, but eventually I got it. So it was pay yourself first. And basically what that means is try to live on 80 to 90% of your income. Take that delta, 10 to 20% of it, and invest it. Invest it in real estate, invest it in stocks. I don't care. The secret is creating that delta and then putting that money to work for you. So that was great advice. I can honestly say I didn't get it at the age of 23, but eventually it sunk in. So pay yourself first, live below your means.
Yeah, most of wealth is just really what's the difference between your income and your expenses.
Yeah.
Our third one is, what are you most proud of in your life?
I'd say I'm most proud of being in the real estate business 45 years, building a business on relationships, on integrity. My clients and investors can trust what I say. And so that's what I'm most proud about. Real estate can sometimes be competitive and confrontational. And I can honestly say in 45 years, I've never been in a legal dispute. And that's just, you go about and you conduct business with character, integrity, you do the right thing. If you make a mistake, own up to it and move on. And so I'm proud of that record. And I think people appreciate that about me.
Yeah. Well, our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
So how about Albert Einstein?
Okay.
And it's strange. We bought a house in Greenville, South Carolina, that Albert's son Hans actually lived in back in 1938 when it was built. And it's all been documented. They had a son who died and there's a death certificate. So cool guy, great thinker, but not only about math and science, he has a lot of good quotes just about life and how you think about things. So yeah, I'd love to have some ice cream with him. And I suspect he might actually like ice cream. I don't know for sure, but if I had to guess, I'd say he probably does.
He looks like a guy that would like some ice cream.
Yes.
Well, Arn, fantastic conversation. If our listeners wanted to reach out to you or learn more about you and what you've got going on, where is the best place we could point them?
So I'm very active on social media, either Facebook or LinkedIn, under Arn Cenedella or Spark Investment Group. Website is investwithspark.com. So those are the best places to get me.
Perfect. We will link those in the show notes. And then, Arn, thanks for coming on.
Thanks, Matt, and thank you so much.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.